Let us see the next question. RC Manufacturing Company is considering a proposal to replace one of its existing machinery by CNC machine. In this connection, the following information is available. The existing machinery was purchased 3 years before for rupees 15,40,000. It was depreciated on SLM basis and has a remaining life of 7 years. Its annual maintenance cost is expected to increase by rupees 40,000 from 6th year of its installation. Its present realizable value is 6,50,000. The purchase price of the CNC machinery is 27 lakhs and installation expenses of rupees 95,000 will be incurred. Subsidy equal to 15% of the purchase price. Purchase price is 27 lakhs. So of that, say the 15% will be received at the end of the first year. It will be received but not right now, after 1 year. It is subject to same rate of depreciation. Its realizable value after 7 years will be 5,70,000. With the CNC machinery, annual cash operating costs are expected to decrease by 2,16,000. In addition, CNC machinery would increase productivity, on account of which net cash revenue would increase by 2,76,000 per annum. Income tax rate is only 30%, discounting rate is 11%. Advice: the firm whether to replace the existing machinery with CNC machinery on the basis of NPV, that is a question. Year 1 to year 7, discounting factors information have been provided to us. So friends, over here, again it is a very simple question. The question says that whether to replace the existing machinery with CNC machinery or not, that is a question. Now for this decision making, we can say that again we can adopt an incremental approach for the purpose of decision making. So I want you to do step number 1 to step number 3 for the incremental approach for decision making. Let us have understanding that how to make the calculation of answer. Let us have a discussion first of all. Step number 1 we are focusing, that is investment. Of course, if at all, we continue with the existing machinery. Existing machinery name is CNC. In that case, we don't have to make an investment. And if at all we replace the existing machinery with new machinery, then in that case, the existing machinery with the new machinery, that is CNC. So we understand that if at all we continue with the existing machinery, then in that case there is no investment. And if at all we purchase the new machinery CNC, then in that case 27 lakhs year 0 cash outflow, that is investment. 95,000 year 0 cash outflow, that is again investment. As far as the subsidy is concerned, it is going to be received at the end of the first year. So we will consider that in step number 4. Okay. Just be careful, in step number 2 depreciation, we will deduct the subsidy to compute the depreciation. Fine. Further importantly, we have been provided with the information that as far as the existing machinery is concerned, so it was purchased for 15,40,000 before 3 years and it has the remaining life of 7 years. So 15,40,000 divided by 10, 1,54,000 is the depreciation that we must have claimed for 3 years. So the total amount of the depreciation that we would have claimed is 4,62,000. That is deducted from 1540. So WDV of existing machinery would be 10,78,000. And so that machinery can be sold for an amount of 6,50,000. So we understand that say WDV is 1078, it is sold for 6,50,000. So there is a capital loss of 4,28,000. So 4,28,000 into zero point 0.3, there is a tax saving of 128,400. So if at all we purchase the new machinery, 27 lakhs is outflow. 95,000 is again outflow. Sale value of existing machinery 650 is inflow. Capital loss tax saving is further inflow. This is the way we will have the net investment to be calculated with the replacement of the new machinery. That an answer? The replacement decision in the breakdown, incremental approach, in that replace existing machinery with new machinery CNC. Step number 1, investment. As far as existing machinery is concerned, investment is 0. As far as the new machinery is concerned, the calculation will be made like this. Working note number 1, calculation of depreciation for existing machinery. It is cost divided by number of years. Cost is 15,40,000 divided by number of years is 7 plus 3. So 15,40,000 divided by 10. That comes to 1,54,000 rupees per year. That is the way depreciation for existing machinery. Working note number 2, calculation of current WDV. So the price at which we had purchased it was 15,40,000 less depreciation claimed so far. It is 1,54,000 into 3. 4,62,000. So current WDV 462 is subtracted from 15,40,000. So it is 10,78,000. That is the current WDV of existing machinery. Working note number 3, calculation of capital gain or loss on sale of existing machinery. Scrap value of existing machinery 6,50,000 minus WDV 10,78,000. So difference between both of them is capital loss. $4,28,000. Okay. Then calculation of investment. Purchase new machine for 27 lakhs plus installation expense an amount of 95,000 less sale value of existing machinery 6 lakhs 50,000 less capital loss tax savings. The amount of the capital loss is 4 lakh 28,000 into 30%. 128,400. Based on that, say we'll compute the investment. 27 lakhs plus 95,000 minus 6 lakhs 50,000 minus 128,400. So 20 lakhs 16,600. That is the way step number 1 we will have investment. Step number 2 is depreciation. For existing machinery, rupees 1,54,000 per year. In bracket I am writing calculated above. That we can compute for the coming 7 years. And as far as the new machinery is concerned, for new machinery it is cost plus installation cost minus subsidy minus scrap value of the machinery divided by number of years. Cost is 27 lakhs. Installation cost is 95,000. Subsidy is 27 lakhs into 15%. It is going to be received at the end of the first year, but still it will be deducted. And as far as the accounts is concerned, in that say we do not consider the effect of time value of money. So directly the subsidy amount will be deducted. The question says that say its realizable value after 7 years is 5,70,000. So minus 5,70,000 whole divided by 7 years. So we understand that say it is 27 lakhs plus 95,000 minus 27 lakhs into 15%, 4 lakh 5,000 minus 5 lakh 70,000 whole divided by 7. 27 lakhs plus 95,000 minus 4 lakh 5,000 minus 5 lakh 70,000. So numerator is 18 lakh 20,000 divided by 7. So 2 lakh 60,000 rupees per annum. Again year 1 to year 7. That is with the depreciation for the new machinery. Step number 3, terminal cash flow. For the existing machinery it is 0 because it does not have the scrap value at the end of the 7th year. For new machinery, we understand that say again working note number 1, calculation of capital gain or loss on sale of machinery. Scrap value 5,70,000 minus WDV. 27 lakhs purchase price. 95,000. Sorry. 27 lakhs purchase price plus 95,000 is the installation cost minus 2,70,000 into 15%. Subsidy is, sorry, 27 lakhs into 15%. Subsidy is 4,05,000 minus depreciation 2,60,000 for 7 years. So 260 into 7, 18,20,000, 4,05,000. They are deducted from 27 lakhs and 95,000. So WDV is exactly 570. So there is no capital gain, no capital loss. That is the first working note. Calculation of terminal cash flow. No working capital recovery. So it is scrap value of the machinery 5,70,000. That itself is the terminal cash flow. Now try to prepare the recurring cash flow working on your own. Step number 4 is recurring cash flow. Step number 4 is recurring cash flow. Now dear students, as far as this question is concerned, in this question, it is not possible for us to make the computation of the cash flows of the existing machinery, cash flows with the new machinery, and then you find the difference. That is not possible. Why? Because the sufficient information is not given for that. The question is providing the information only for the differential values. So we do not have a choice but to adopt the incremental approach only for the purpose of making calculation of the cash flow, and at the same time for the purpose of making calculation of NPV. This is an important point of the question. Okay. Let us see, let's say, how to make the calculation of answer. See over here, we are required to make the cash flow series for 1, 2, year 1, 2, 3, 4, 5, 6 and 7. For 7 years we have to prepare the cash flow series. Now the question is providing the information like this. The existing machinery was purchased before 3 years. So 3 years have already been expired, and say it is having the remaining life of 7 years. So 4, 5, 6, 7, 8, 9 and 10. So the total useful life is 10 years. The question is providing the information that its annual maintenance cost is expected to increase by 40,000 rupees from 6th year of its installation. Like that information is given. Okay. So 6th year of the installation, 1, 2, 3, 4, 5, 6. We know that say at this point of time, say we are standing at the end of the 3rd year. So 1, 2, 3. Can we say that say 3rd year from now, its recurring expense, that is the maintenance cost, will increase like that information is given? I am repeating the point. See over here, the question is providing the information that as far as the existing machinery is concerned, it has a total useful life of 10 years, like that information is given. Further, it has been given that say from the 6th year of its installation, the maintenance cost is going to increase. Right now we are standing at the end of the 3rd year. We understand that's the 6th year of its installation. So can we say that it is 3rd year from now? 1, 2, 3, 3rd year from now. So from 3rd year from now, if at all we continue with existing machinery, then in that case the maintenance cost will increase by 40,000. However, if at all we replace this existing machinery now, then in that case we do not have to incur that additional expenses. So what I am doing, friends, I am preparing the cash flow series like this. Year 1, year 2, year 3, year 1, 2, 3 I am doing. I am writing savings of maintenance cost, and I am writing 40,000 rupees that is going to be received from 3rd year onwards till 7th year. So I am writing as year 1 to year 3, and in the 3rd year I am writing 40,000. Next, we understand that say we will be having say certain advantages like this. With the CNC machinery, annual cash operating costs are expected to decrease by 2,16,000. So we will have savings of expenses. It is 2,16,000. And of course it will be year 1, year 2, year 3 and further. There is no need to prepare the cash flow series for the further years. Then next is CNC machinery would increase the productivity, on account of which net cash revenue would increase by 2,76,000. So increase in revenue by 2,76,000. First year, second year, 3rd year and onwards. Okay, so these are the 3 advantages that we have with the replacement of the new machinery. We understand that so the depreciation that we can claim is 260 with the new one. Otherwise it would be 2, that is 1,54,000. So 260 minus 154. So there is an increase in the depreciation by 1,06,000. So depreciation 106. Year 1 to year 7 once again. So we will have profit before taxes, profit after taxes, add back depreciation, CFAT, subsidy. We are going to receive the subsidy at the end of first year. It is 15% of 27 lakhs. And that is the way the cash flow will be found. Then later on in step number 5, we'll have the discounting of the cash flow series for NPV calculation. This is the way we are required to prepare the cash flow series for year 1 to year 3 for the purpose of NPV calculation. So write down answer along with me. So it is year 1, year 2 and year 3. Savings of maintenance expenses will start from the 4th year onwards. Next is reduction in cash operating expenses. Reduction in cash operating expenses. That is an amount of 2,16,000. It will be every year for 7 years. Next is increase in the net revenue, 2,76,000. Increase in net revenue, 2,76,000.